Welcome back to the XFO Family Office Insights August 2026 edition. In Episode 2, today we are looking at the direct investment supercycle and asking, who is actually the marginal buyer in private markets right now? It is no longer the mega-cap private equity firm. It is the family office. In June 2026 alone, we tracked nearly $20 billion in direct family office investments. Just look at Bezos' expeditions. They were involved in 4 of the top 10 deals that single month, pouring billions into physical AI, fusion energy, neurotech, and green steel. Why are family offices consistently winning these highly contested deals? Because they possess the one asset traditional private equity cannot buy: time. PE funds are trapped in a rigid 5 to 7 year life cycle, forced to buy, optimize, and sell. Family offices answer to no outside limited partners. They can underwrite a commercial fusion reactor or a longevity biotech startup, assets that take a decade or more to mature. According to UBS, 60% of family offices are actively changing their strategic asset allocations this year, and they are leaning heavily into these long-term structural themes. The biggest theme, without question, is artificial intelligence. UBS reports that 65% of family offices are now allocated to AI. And they aren't just buying semiconductor stocks. They are deploying capital across the entire value chain, from data center infrastructure to AI-enabled healthcare. As one Asian family office CEO recently noted, FOMO is driving families to invest in both the rival AI ecosystems developing in the US and China simultaneously. But patient capital is also flowing into the $2 trillion sports economy. Morgan Stanley recently highlighted how major global leagues are finally opening their doors to institutional private capital. Why? Because sports demand is incredibly sticky. Fans don't cancel their fandom after a losing season. Media rights and long-term sponsorships provide predictable cash flows that behave completely differently from public market equities. For a modern family office, sports ownership isn't a vanity project. It's an uncorrelated, multi-generational asset class. To execute at this scale, the family office itself has had to evolve into an institutional machine. Wharton's latest survey shows that over half of single-family offices are now achieving double-digit net returns, and they are rapidly bringing operations in-house. Over a third of their investment spending is now insourced. They are even using AI as a diligence force multiplier to pressure test investment theses and automate complex alternative asset reporting. But here is our core XFO view for this episode, and it serves as a vital warning. Patience is not alpha, containment is alpha. The same patience that allows a family office to fund a decade-long AI infrastructure build-out can, if ungoverned, lead to catastrophic operational blind spots. We are seeing a massive bifurcation in the market. The institutionalized core, the offices with rigorous cyber defenses, formal governance, and deep talent retention, are successfully compounding their wealth. The long tail, operating like a principal with a spreadsheet, is leaking capital to fraud, bad deals, and operational friction. The illiquidity premium of direct investing is only harvested by offices whose internal governance is just as sophisticated as their external convictions. If you want to understand how the world's most sophisticated capital is deploying into AI, sports, and deep tech, please save this video and subscribe to the channel. To request a full copy of the XFO Family Office Insights August 2026 report at a special discount, or to ask for details about our thought leadership as a service, email us directly at xfointelligence@gmail.com. Disclaimer: the views expressed in this broadcast are for informational purposes only and do not constitute investment, legal, or tax advice. Past performance is not indicative of future results. Always consult with a qualified professional before making any financial or strategic decisions.